Now you can get with this or you can get with that. You can get with this or you can get with that. You can get with this or you can get with that. You can get with this because this may be where you're at if you don't understand how credit works. Credit works on a scale from 300 to 850, and where you are depends on a lot when it comes to buying a home. I hope that doesn't scare you. I just want to be the one that educates you to tell you about my brand, Educate to Own. Hi, I'm Stephanie Stewart out of Milwaukee, Wisconsin. I am brokered through eXp Realty, and my brand is Educate to Own Realty, where I'm able to help people go ahead and get through the home buying process. So one thing that some of my clients and customers face are credit challenges. It's okay. 80% of Americans have them. So don't think you're not one with the bag. There's some people who are in the green and there's some people who are not in the green, and all that's okay based off your own financial track. Maybe it's student loans, or maybe you just don't have any credit. Maybe there's things that can be removed or added, or maybe you can build positive credit. But there's definitely things that you can go where I just don't want you to, have that when you can have that, because that comes with a scope of work and some repairs and some sweat equity and maybe more money and stress than you thought about if you would have just known what it takes to get to something like that. So let's talk about credit. When it comes to credit, let's first start off by saying your free credit app is free, so it makes you knowledgeable, but that score may not be what the actual lenders are looking for. So there's a difference between a credit score and a FICO score. There's the public score that you see and the score that the lenders see. This may have a few more things than what's on your traditional credit report. And this is how they definitely assess how you've been over the lifespan that you've actually built credit. So on the screen above, there are ranges, as I stated before. There are some that are going to give you either non-qualifications or very, very high down payments with those, versus ones that have very good interest rates, very low down payments. And then those who may have a higher down payment, but has lower interest rate or lower payments over the life of the loan. Where you are depends on where you are financially and what fits best for you. So never take what I'm saying as a you have to do this. Believe me, it all works for you. I am not a financial advisor and or lender. So definitely go ahead and meet with your local lender to verify some of the information that I'm saying and what works best for you. But one thing I've seen across the board is some things that I'll share with you. For instance, in order to get a home, you're looking at a minimum of about 640. This means you may be in the red zone, but you have the ability to go ahead and climb your way up. But now keep in mind, this says you may qualify for most loans and at a significantly higher interest rate. This means the amount of money you pay per month to have this home mortgage is going to be higher because you may have some bad debts. If you are leaning more so towards above average, so this 720 range, now you're looking at slightly higher interest rates, but not necessarily the highest interest rates. The sweet spot is really up here in this 740 and up range. When you have a 740, now you're qualifying for the best interest rates. This means you are borrowing money and you're not putting more down for your interest than your principal. The idea is to put more on your principal to be able to pay it off faster versus the other way around. When you are able to get into the 800 club or that 820 where you're seen to have excellent credit, ideal, now you're able to get even lower interest rates. I mean, the best of the best. So that 3% that they've been advertising, let's talk about maybe 2%, maybe 1.5%, maybe 1%. There's going to be so many things out there that they're just going to throw you money because you've shown how well you are when it comes to taking care of money, your finances, your debt to income ratios, and kind of how to definitely get ahead. So that was just a quick video on credit and how credit is going to go ahead and be categorized when it goes on the chart But one also thing I want to explain is why credit is important. So let's really talk about it. When it comes to credit, credit is what has been calculated as far as what you've been doing over the lifespan of you. So maybe that was student loans. Maybe you got a credit card, didn't quite understand it, and you were late a couple times. Maybe you forgot about it. When you get past a certain credit score, they kind of start just throwing them at you. So you kind of lose track of when they're all due. But let's really just dive in and talk about what it means to have good or bad credit. So, when it comes to having good or bad credit, it's going to really depend on these three things. Your credit score affects how much money you put down, it affects what type of loan you have, and the interest rate, so how much you pay over time. So, as crazy as it sounds, that number is imperative to make sure that you're paying the lowest amount over the lifespan of the loan versus a higher amount. Because over the course of 15 to 30 years, we get older, which means that we may not be at the same job, may not get the same wage. If we're younger, then yes, we may get that, promotion. We may be able to go to those successes. But if we're getting older, not to put a damper on it, but there's a high probability that we're going to now start to rely on our pensions or our 401ks or our retirement avenues versus wanting to have such an extraneous mortgage versus not having one. So let's talk about how to fix the credit. I don't want to just say, oh, if you have bad credit, now you're not qualified. Let's talk about how to actually fix that credit. When it comes to fixing credit, you're going to definitely pay your bills on time. This means getting a calendar, writing it out maybe 2-3 days before it's even due to say, hey, pay this bill. This ensures that it is paid on time. If you're really savvy, do a week before, and it has the biggest impact on your score. 35% just for paying it on time. In addition to that, you're going to want to use a service that monitors your credit. I have some wonderful resources that I would love to be able to share with you. I can attach the link down in the comments so you can go ahead and find more about it. But then you're going to want to keep the debt on your credit cards or your credit limit down. You want it to be ideally less than 30%. 30% is where they want you at, but it would be better if it was at 20. Even better if it was at 10. You want to look like you don't need this money. You want to keep those old cards open. So that old furniture card that you got and you paid off the furniture already, it's one of those things where you might want to just go buy a pillow, buy something to, not necessarily max it out, but keep that card open because it's going to add to the average life of your credit history, which can definitely help you when it comes to increasing your credit score. Then you're going to limit opening new accounts. This means when you're going to build your credit, you don't want to get more credit cards. You don't want to extend by co-signing or adding yourself to somebody else where you're not actually in the midst of the entire financial responsibility. That person may max out their card and it may affect your score when you're trying to get a home. I've run into countless times where people try and use other people to get ahead, but the goals aren't quite lined up and they didn't quite have that communication to say, hey, I'm trying to get a house. Don't max out your card, especially with the holidays coming up. If things are inevitable. So I want to teach you how to do it for you because I want to teach you how to definitely stand on your own 2 feet. So let's actually break down the credit score. Credit score is broken down into 5 different areas. You have your payment history, which is 35%. You have your level of debt. So how much debt you're in. The age of your credit, as far as it's 1 year, 5 years, 10 years, 20 years or more. The types of credit you have available. So maybe you have a mortgage, maybe you have a car loan, maybe you have some collections, maybe you have, whatever different types of things on your credit. How is your portfolio diversified in building wealth? And then the last percent is the 10% of they want to know how many times have you had credit inquiries? How many times have you maybe tried to get a loan or tried to get another credit card, or people were doing hard pulls on your credit and it's decreasing your score? When people are doing so many hard pulls, it looks like you need the money, which is going to negatively affect the credit score. So Thank you guys for tuning in. This is Stephanie Stewart coming out of Milwaukee, Wisconsin. My brand is Educate to Own Realty. I am brokered through EXP Realty. And I am here to definitely give you some quick tips and tricks to go ahead and get through the home buying process. I'm really just here to educate you and just show you how to go ahead and get ahead, how to get those interest rates low, how to pay your mortgage off in record time, and how to go ahead and build that equity and that appreciation to really go ahead with your next investment goal, if that is what you choose to do, or just kind of have that to be able to do your home updates. If you like this video, please hit the like button and share with your closest friends and family to go ahead and share this message to make sure they know how to go ahead and keep their credit up, because that is imperative when it comes to buying a home. Tune into our next video and see you next time.